Hi, I am CA Vijay Kedia. In today's video, we are going to talk about debt mutual fund, and I am also going to give you two strong reasons why it's a good time to invest in debt mutual funds. So stay till the end of this video and do subscribe to the channel if you have not done already. So let's start with the first reason why I think it's a good time to invest in debt mutual fund. So the first reason is the falling interest rates. You might have heard recently, Federal Reserve in US has reduced the interest rate by 0.25%. Bank of England has also reduced the rates sometime back by the same percentage. And in India also, RBI is supposed to reduce the interest rate, if not in this quarter, probably in the first quarter of 2025. We'll see that reduction. So now the downward cycle of the interest rate would start. And you would ask why reducing interest rate is good for debt mutual fund. So the reason is there's an inverse relationship between rate of interest and the return of debt mutual funds. When the interest rate falls, the bond prices increase, and when the interest rate increase, the bond prices fall. This I am going to explain you with the help of an Excel sheet in a bit. And second reason is the market volatility. So you might have seen recently markets are running sideways. So we have seen some fall in October, then market try to regain its momentum, then again it's falling down. So it's basically running sideways and it's very volatile right now. So if you are not comfortable with this kind of market volatility, then debt mutual fund is a good place to park your fund with much lesser risk. And even if you are a aggressive investor, it's not recommended to have more than 80% of equity in your portfolio. You still need 20% allocation to debt, gold, or other asset classes. And if you are a, say, conservative investor, you want to keep 50% in debt, 50% in equity. And recently we have seen equities have given a good run, and so you might have overshoot your allocation to equity, and your allocation to other asset classes might have reduced. So this is a good time to balance your portfolio by having some allocation to debt fund. Now let's see how a falling interest rate affects the return of debt mutual funds. So we know a debt mutual fund invests in the bonds issued by companies, government, banks. So let's say a mutual fund has invested in a bond which has a face value of 100, and then there is a coupon rate. So for example, the coupon rate for which for the bond is 7%, right? So 7% interest that bond issuer, whether that's company or government, is going to pay to the holder of that bond. So 7% is the coupon rate. Now say uh, the current interest rate has reduced, so now the interest rate is 6%, which is we are expecting in the coming quarters that interest rate would reduce. So say if that interest rate reduces to 6, then what will happen is if someone purchases a new bond, they'll get a interest rate of 6% coupon rate. But this bond was issued in past, and which still has some time left to maturity. So maybe it was issued for 3 years, 5 years, 7 years, right? So this bond will continue to get 7% interest, though the interest rate has fallen to 6%. So in this case, what will happen is people would be ready to pay an higher price for this bond in the secondary market. Say somebody is willing to pay 110 for this bond because they are getting 7% coupon rate, which is higher than the current interest rate. And if you calculate the yield, so what is the yield of that bond? So what is the coupon rate for that, and what is the purchase price or the current bond price? So if you see, for this 7%, even if somebody purchase that bond for 110, they'll get 6.36% as a yield, right? So it makes sense for that buyer to buy it at 110 or even at higher price, because the yield which they'll get on that bond would still be higher than the current interest rate. And that is the reason buyer is ready to pay an higher price for the bond in the falling rate scenario. So the bond prices will increase, and the mutual fund which are holding those bond, their net asset value would increase. So that's the kind of relationship we have, that if the interest rate falls and we have the bond with the higher maturity and with the higher interest rate, then the bond prices would increase because they would still give a good yield compared to the current interest rate. Then in the second scenario, say again the bond face value is 100, coupon rate is 7, but interest rates have increased. So now say the interest rate is 8%, right? So what will happen to the bond price? So people would like to pay only 90 for this bond, because if you calculate the yield for this 90, right, at this 90, the yield is 7.77%, which is less than the current interest rate. So buyer might be willing to pay even less than 90 to buy that bond, right? So this is the relationship which I wanted to explain, that if the current interest rate is reducing, your bond price would increase and you'll have higher returns in the debt mutual fund. If the interest rate is increasing, then your bond prices will fall and you'll see a lesser returns in debt mutual funds. Now let's see what all types of debt mutual funds we can have. So I have categorized the debt mutual funds into two category. One is which invest in money market instruments with maturity less than 1 year. So money market instruments are very short-term kind of instruments which are issued by companies or banks and government, right? So for example, certificate of deposit, commercial paper, treasury bills. These instruments can be from 1 day to up to 1 year. And so there can be different type of funds which are investing in money market instrument depending on the duration. So overnight fund invest in instruments with maturity of up to 1 day, so which is very short. Liquid fund will invest in with maturity up to 90 days. Ultra short duration funds, they'll go for instruments with 3 to 6 months of maturity. And low duration funds is up to 12 months of maturity they'll invest in. This is the kind of return you can expect from short duration funds, that so you'll get like 5 to 8%. But again, it would depend on whether it's a very short duration kind of fund or it's a low duration fund. So depending on the holding period, depending on that maturity of that instrument, rate would slightly increase. And again, it would also depend on the interest rate scenario. Based on that, you should expect between 5 to 8% of the return in this short duration fund, which invest in instruments with less than 1 year of maturity, right? And next, I have classified as medium and long duration funds, which are investing in instruments which has more than 1 year of maturity, right? So first is the short duration fund. So short duration fund is, it invests in instruments which are having maturity more than 1 year. The instrument should have maturity of up to 3 years only. So money market instruments for up to 1 year of maturity they invest, and also the debt securities which are issued by the government or issued by the companies uh, up to 3 years. There also they invest. Then on the higher duration, there can be three type of funds. One is the corporate bond fund, which invest in the bond issued by the companies, and they are typically of 3 to 7 years duration. And then gilt funds, where they invest only in government securities, whether issued by central or state government. Maturity can be as short as 1 year and it can be up to 10 years. And then banking and PSU funds, they'll invest in the debt instrument which are issued by the banks or the public sector companies. So, and they are typically 2 to 5 years of maturity. And then there is a credit risk fund. I personally don't prefer this kind of fund. So, normally corporate bond funds would invest in the top rated funds, right? Which has a very high safety rating. But a credit risk fund will go below the highest rating and to get some more return. So the point here is, if I want to take risk, then I would take risk in equity and not in debt, because my purpose of investing in debt is that I want safety of my investment. So I personally don't prefer investing in credit risk fund for slightly higher return. and you can expect slightly higher return than the money market funds. Here you can expect up to 6 to 9% of return, again depending on what type of funds you are investing in, what is your duration, what is the current interest rate scenario. Depending on that, you can expect this kind of return with your medium and long duration funds. These are some of the details related to debt mutual fund which I wanted to share with you. Hope this would help you to maintain your asset allocation in your portfolio. If you like this video, please hit the like button, subscribe to the channel if you have not done already, and please do share with your friends and family. And I'll see you in the next video. Thank you.